Hello and welcome. In this video, we will look at the effect of bonus shares on EPS. Okay, and before we do that, I'll talk a little bit about dividends and buyback of shares. Okay, now if a company feels that it has enough reserves and surplus, then it can share some of the amount with its shareholders in many ways. Okay, and in this video we will be actually talking about three ways. First way is to give out dividend to its shareholders. Okay, let us see why and how the company does it. All right, now you see, a company has shareholders, and generally the promoters will be the major shareholders of a company. And let us say that the promoters need money. Okay, so here I have written majority shareholders. So majority shareholders meaning promoters. Okay, so let us say the promoters need money. Why do they need money? Maybe they have a loan which they have to repay, or maybe they want to invest the money or invest some money somewhere else, or they want to uh, have some money to take care of some personal needs. Okay, but they want some money. Now, the company can give dividends at this time to satisfy this need. Okay, now what is a dividend? You know that a dividend is a part of the profit that is given to its shareholders, correct? So when a dividend is given to its shareholders, shareholders get the money. Okay, the promoters along with the retail shareholders, people like you and me, get the money with which we can do the needful. Okay, so the promoters and people like us both get money when dividend is given, and we can do whatever we want with the money. Okay, now where is this money given from? It is given from reserves and surplus. Okay, so that is one way to share the money, the profit with shareholders. Why do they do it? Because the shareholders need money, and at that time giving a dividend seems the right option to the management. Okay, next is buyback. Let us say that a company XYZ is being traded, or the shares of a company XYZ or Z is being traded in the stock exchange at 100 rupees per share, or the current market price of the share of XYZ company is 100 rupees. The company feels that this is low price. They feel that the share should be worth more. They feel that the company is doing good, and for what the company is doing, 100 rupees is very less. So what they want to do is they want to increase the positive sentiment about the company among the shareholders or the public. And why do they want to do that? They want to do that so that the market price increases. Okay, and how do they do that? They do it by offering a buyback. Okay, one method is buyback. So what the company does is it offers buyback at the ratio of 1:5. This is just a random ratio. Okay, it is not that it has to offer at 1:5. It can be any ratio. So this is just random. Okay, so the company offers buyback at a ratio of 1:5 and at 150 rupees, meaning the company says that if you have 5 shares, you can give us 1 share, and we are ready to buy that one share at 150 rupees each. Okay, so current market price is 100 rupees, but the company says that we are willing to pay 150 rupees per share. So meaning is that if I have 5 shares, I can give one share to the company and get 150 rupees. If I have 50 shares, I can give 10 shares to the company and get 150 into 10. Okay. Now, the company has to pay me money, correct? If I have 5 shares, let us say, for example, I have 5 shares, let us say I am willing to sell one share to the company. So the company has to give me 150 rupees. So where does it give it from? So the face value is given from the share capital and the remaining is given from reserves and surplus. Now what do I mean by face value and remaining value? So you already know what face value is, correct? So let us say that face value of this company is 10 rupees. So 10 rupees is given from this. Okay, 10 rupees is taken from this and given to me. Remaining 140 rupees, 140 rupees is taken from reserves and surplus and given to me. So 10 plus 140 is 150, and that is what the company gives me and buys one share from me. Okay. So the company takes face value amount from this, remaining from this. Alright. Now, let us say that before buyback, the company has 10 crore shares. Okay. And after buyback, 9 crore shares are being traded in the market. Now see, if a company offers buyback, it is not mandatory for the shareholders to sell the shares to the company. For example, if I have 5 shares, the company is willing to buy one, but it is not mandatory for me to sell one. I can sell if I want. If not, I can keep quiet. Okay. Now, let us say that after buyback, 9 crore shares are being traded in the market, meaning 1 crore shares have been bought back by the company. So what does the company do with the shares that it has bought from the shareholders? It destroys it. So 1 crore shares are destroyed. They are eliminated from the book and the records too. Okay. Now, share capital and reserves and surplus of the company reduces. Why? Because the company has already paid to the shareholders to buy back 1 crore shares. Okay. 1 crore into 150 rupees. And out of that 150 rupees, the face value amount is from share capital and the remaining is from reserves and surplus. So both reduces. Okay. Now, both reduces, but why does the company do it? Because they want to increase the public sentiment. How does the public sentiment increase or improve? The public thinks that, okay, so the company itself is ready to pay 150 rupees to the shareholders and buy it. Meaning, the company thinks that it is performing well, and the company expects, or the management expects, the company to perform well in the future too. So the public thinks that the shares must be worth more, and so what the public does is goes and buys the shares of the company. Okay. So when when public goes and buys share, the demand increases. Now the supply has been reduced. See, it was 10 crores before. Now it is 9 crores. 1 crore has been removed. So the supply has been reduced. The demand increases. So the price of the share increases. And that is what the company wanted. Okay? Yes. Now, there are two types of buybacks. company buyback and promoter buyback. If you read a headline saying that company is going for a buyback, then it generally means it is company buyback. That is what I have explained right now. One more type of buyback is promoter buyback. It is when promoters buy the shares from the shareholders. Okay, so let us look at that now. Let us say that promoters have 50% stake or shares in a company. Okay, same company XYZ. Let us say that promoters have 50% of the shares of that company, and let us say that they want to increase it to 60%. Okay, they want to increase it to 60%. Now they can go to the stock exchange and they can buy shares from the public, correct? Of course they can, but it would be against the law. The law does not permit, the rules does not permit the promoters to buy at current market price from the public. Okay, see, when you are trading in stock exchange, you do not know from whom you are buying, correct? So buyer and seller will be anonymous. So if I buy a stock or a share from the share market, I will not be knowing who has sold it to me. Okay, so the promoters can go and buy from the stock market, but the rule does not allow them to. Okay, the rule forbids them from buying in the share market. If they have to buy, they have to notify exchange, and there are procedures to be followed. So let us not go there, but let us continue with this example. The promoters are willing to pay 150 rupees per share to the public to buy shares from them. Okay, and why do they do that? They do that because they feel that the company will perform good in the future. Okay, and they are willing to pay more. Now this is one case. They have 50% of shares or any percentage of shares, and they want to increase it to 60%. They sometimes may want to have 100% of the shares and delist a company from the stock exchange. Okay, so sometimes they have an intention to do that too. Initially, using IPO, they sold the shares, but now, since the company is doing good, since everything is fine, they feel that they should own 100% of the company, of the stake, and so they are willing to buy the rest from public. And once it reaches 100%, or once they have 100% of shares, they will delist the company from stock exchange, meaning public cannot trade anything because there will not be any shares to trade in the market. Okay, that might be one of the reason too. Now they are ready to pay 150 rupees. Now if they want to pay, they have to pay it from their pocket. You see, here the shares are not destroyed. The shares go to the promoters. They are not destroyed in the process. They have to pay the money from their pocket to the shareholders and buy shares from them. So the share capital and reserves and surplus of the company does not reduce. Okay, and if they achieve that, if they are successful in doing that, then it would be called as promoter buyback. Okay, and to do that, they have to inform the exchange and carry out the transaction. The rules do not allow promoters to buy slowly from the stock market, but it allows them to buy in bulk at higher price. All right, now coming to bonus shares. Let us say that a company XYZ has its stock shares in the market, and let us say the current market price of the company is 10,000 rupees. Meaning, if I want to buy one share of this company, I will have to pay 10,000 rupees. Alright. Meaning, if I have 1 lakh rupees, I will be able to buy only 10 shares. Now, this seems costly to retail people or general public, I can say. Let me consider myself itself. I feel that 10,000 rupees per share is very costly. And let us say that I only have 20,000 rupees to invest in stock market. So I have a lot of options. I can buy cheap or less pricey stocks, or I can go with this and buy only 2 shares. Now, the company knows this. Company knows that this is costly. When shares become costly, liquidity will be less. Now, do not worry about liquidity too. Just know that too much public participation will not be there. Now, the company wants public to participate more in trading. So, what it does is it offers bonus shares. It goes for 1:1 ratio of bonus shares. Once again, this is a random ratio. It can be any ratio. Okay. So for this example, I have taken 1:1. So let us say that company goes for issuing bonus shares at ratio of 1:1. Meaning, if I have one share, I will get one share free. I don't have to pay anything to the company. In the case of dividend, in the case of buyback, the company paid me money. But here, the company does not pay me anything. Okay? If I have one share, I will get one free. If I have 32 shares, I will get 32 shares free. Alright. So, what happens? The share capital doubles. Share capital doubles. So, 6765 would double. So, this would be this plus this. Now, when we say it doubles, the money has to reach here from somewhere, correct? Where does it reach from? From reserves and surplus. You see, the company doesn't take any money from shareholders. Company is offering 1:1 for free. Now, you cannot just offer anything for free. The money has to go to the company from somewhere. So what happens is, from the reserves and surplus, money goes to share capital, and that's all. See, both are shareholders' money. It doesn't matter if the money is here or here. But in the book of records, the money goes from here to here. So this would be this minus this would be this plus this. Okay? Next, what happens due to issue of bonus shares? The market price reduces to 5,000, which is half. In reality, it may not reduce to 5,000. I have already discussed why in my video, which explains what bonus shares are. But let me quickly explain why that happens here. See, when the company offers bonus shares, generally the sentiment in people will be good. People think that the company is doing good, company will perform better, company has enough reserves and surplus, that is why it is offering bonus shares, and so it is a good time to buy the shares of the company. This is what the public thinks. So what the public does is it goes and buys shares, and when they buy shares, the market price increases. Okay, so in reality, it should really reduce to 5,000. It should reduce to half, but it may not happen so. I am saying it may not. It may happen, it may not too. Alright. Now, when number of shares are increased, the volume being traded in the market increases. So, more people can participate in trading. The price has reduced, so more people, so it becomes affordable to many people. Okay, so demand increases, and so the share price increases too. Alright. Now let us look at EPS. You know what EPS is, we have already learned about it. Now let us say that before issuing bonus shares, 10 crore rupees was shared among 1 crore shares. Okay, let us say that the company has 1 crore shares. Before issuing bonus shares, 10 crore rupees was shared among 1 crore shares. Now after issuing bonus shares, 10 crore rupees will be shared among 2 crore shares. Correct? So this has doubled. Number of shares has doubled. But the amount to be shared among shares is still 10 crores. So you may think that your earning per share, your earnings per share would reduce by 50%. You would be correct. But then your number of shares have doubled. Correct? If I had one share before issue of bonus shares, I would be having 2 now. So if before issuing bonus shares, my earnings per share was 10 rupees for one share, now it would be 5 rupees for 2 shares. So before bonus shares, I was getting 10 rupees. After bonus shares, I am still getting 10 rupees. Okay. So EPS reduces, but since the number of shares have doubled, the earnings remain same. Okay. Unless you sell the shares in the market. Okay. So I hope the concept is clear. So this is the effect of bonus shares on EPS. Okay. So that's it for this video. I'll see you in the next video. Till then, take care and thank you for watching.